There are a plethora of funds that are available in the market to invest your hard-earned money in. But like one-size shoes cannot fit all, one style of mutual funds will not meet your return expectation and everyone's risk and taking ability as well. So now the big question is, how do you assess which is the right fund for your portfolio? And what are the criteria that one should look at to help you navigate this tough task? We have on board Mrin Agrawal, founder and director of FinSafe, as well as Mr. Amol Joshi, who is the founder of Plan Rupee Investment Services, is also joining us. Good evening to both of you and welcome to ET Money Show. Firstly, Mrin, would like to come to you to help us understand our viewers what exactly is mutual funds, what are the basics, and what are the different types of mutual funds that are available in market that they can be looking at.
So, good evening, and it's lovely to be here today. Mutual funds are a pooled investment vehicle. So, if you were to go on your own and try to figure out what stock to buy, what quantity to buy, how long to hold it, it's going to be really difficult. So, an easier way to do it is with a mutual fund where you have a professional fund manager who manages these investments. Now, there are different types of funds. There are funds which invest in stocks, there's funds which invest in bonds, and then you have the hybrid funds which invest in stocks and bonds. And as far as how do you choose a fund, well, a fund has to be chosen essentially based on two parameters. And the first is, of course, what is your financial goal? Because it's only when you know what is your financial goal that you would know how long you can hold the investment. So a fund really has to be chosen based on how long can you hold an investment, and the second thing, your risk profile. So for example, if your holding period is just a couple of years, then of course equity funds can be extremely volatile in that period, and hence you may not look at choosing equity funds. But in longer term periods, even though equity funds might be the apt ones, if your risk profile does not permit it, so if you don't want to take that much risk, you might go in for a debt fund or a balance fund. So it's chosen based on your investment period and your risk profile.
Okay, so those are the points that you should be taking care of while picking in a mutual fund for yourself to invest. But Amol, now coming to you, I'm sure that you will agree to Mrin's point, but is there anything from your advice that you should be telling our viewers that when they are picking a mutual fund for themselves, what are the points that they should be taking care of?
Right. Good evening, Srishti. So yes, you are right. I agree with what Mrin said just now. Mutual funds are a pool of investments managed by a professional fund manager. Not all of us can pick stocks. And what do we do in that case is we go to mutual funds. Coming to what are the other factors in addition that you can look at. So something that is very, very fundamental in the entire investment journey for all the investors is asset allocation. And side by side, I would also say, not looking at past returns. You mentioned some of the more points, additional points, what every mutual fund investor should be considerate about. So as Mrin rightly said, a lot would depend, the schemes that you would choose would depend on your risk appetite. At the same time, if your goal is or investment horizon is really, really long term, so somebody who joins the workforce at 25 or something like that and is retiring, and the contribution towards provident fund, as you and me both know, these days for last several years, the provident fund contribution, which was earlier 100% a debt component, as also now invests a good chunk of money into equity. So asset allocation is something that you cannot ignore. Your point regarding risk appetite is very well taken, but you should strike a balance between debt asset allocation and equity. And maybe there are other minor asset classes also that you could pay attention to, but not for a lay investor or a beginner. And those asset classes are probably precious metals. Most commonly, gold is where you would invest, and something like an international diversification. That was one point that I would like to cover. And the second one is not looking at past returns. There have been several phases If you are at the end of a rate cutting cycle, you would see that a long-term GSEC fund has done really, really well. Many cases it has beaten, or it would theoretically beat several equity funds as well. That doesn't necessarily mean that at a end of rate cutting cycle, you would go and invest into a long-term, long duration bond fund. The same thing applies to equity as well. There have been phases where mid and small caps have delivered 40-60% kind of 1-year returns. You are advised, all the viewers and mutual fund investors are advised not to look at past returns and decide them as the sole criteria to choose your mutual fund investments. Please avoid that.
Well, yes, those are the points to be taken, because what generally people do is that this particular mutual fund has been performing very well for the past so many years. So going forward, the outlook looks good to them, and that's why they pick that mutual fund going forward as well. But that's not the right strategy, is what our expert is trying to highlight. But Mrin, coming to you, when it comes to return expectations, so what kind of return expectation should one keep while investing in mutual fund, definitely for a longer term horizon? On a CAGR basis, what is that you have experienced so far in so many different cycles, as well as keeping so many parameters in view, like for now that there is inflationary concerns, there is interest rates hike. So how do you adjust the returns when it comes to mutual funds?
Well, I think as far as equity funds are concerned, I think I would always play it very conservative, honestly, where returns are concerned, whether it is equities or it's debt. And I would always say that, you see, I mean, nobody is going to have only one category of funds. They're going to have different categories of funds in their portfolio. So they might have large cap, mid cap, maybe some amount of small cap. So I would say that on an average, the return expectations, irrespective of whatever has happened in the past, because and Amol just talked about the fact that we shouldn't be looking at the past returns, and they really don't have a bearing on the future. I would say going ahead, I think the return expectations should be in the range of about maybe 11 to 13% on a blended basis when you look at a blended portfolio. So I would look at those sort of returns really going forward. And of course, on the debt side, it could be anywhere between 7.5% sort of returns going forward. So yes, I mean, if inflation does remain high, then of course, you will need to look at a combination of debt and equity in your portfolio in order to be able to beat the inflation.
Okay, so those are the return expectations that you should be having from your mutual fund portfolio. But coming to you, because now what we see, Amol, is that investing is not just return expectation, but there's always a risk factor associated. So would you like to highlight for our viewers, when you're going for mutual fund investments, what are the risks that you should be at least knowing about, that you are well prepared, or what could be your next strategy on, so you have the time to decide on? Would you like to touch upon this?
Yes, absolutely. And in a lighter vein, the simple reason is this risk factor, nobody highlights it more than mutual fund industry, we ourselves do. So if you have watched television ever, I'm sure that you have come across ad campaign run by Amphi and mutual fund industry. And it always ends with mutual fund returns are subject to market risk, right? This is the first half of the disclaimer that is always played at the end of any mutual fund advertisement. So market risk is inherent part of investing into mutual fund. So coming back to what are the risks, market risk, it's not simply, and this is a very important point. Typically people have this notion that when anybody says the word market, people typically would feel that market simply means that equity market. It is not necessarily true. Debt market or the bonds that are regularly traded, bought and sold, that also is a debt market, and within debt market also there are elements of volatility. In fact, in debt or fixed income asset class, there are several risks like credit risk, reinvestment risk, so on and so forth. Again, as I mentioned in my previous answer, for a lay investor or beginner sort of an investor, within debt segment, it is always a good idea to stick with high credit quality, something like a AAA rated short-term fund or medium-term fund. That's as far as debt component is concerned. And within equity, you always remember that your capital is at risk. Only when you remain invested for extended periods of time, your returns would have, assuming that market has done well and you probably have participated via SIPs, thereby getting the rupee cost averaging for your portfolio, so on and so forth. Only with the time, equity becomes kind of the hit kind of reduces. To give an example, just imagine somebody who invested in early part of 2020 and market crashed somewhere to the tune of 30-35%. So that is once in a decade or once or twice in a decade kind of an event. But always remember, in equity, pay attention to valuation and always follow your risk appetite, stay longer horizon to mitigate the market risks that are inherent to equities and stocks.
Okay, point taken. So those are the risks that you should be concerned about, and that was the discussion all about when you are actually going to pick a mutual fund. What are the factors that you should be taking care about? But now it's time to begin our queries that our viewers have sent to us. And firstly, let me take the query of Anurag. He writes that he's 23-year-old right now and he has got his first job this year. Firstly, congratulations, Anurag. But he's sharing his monthly income with us, that is around 40,000 of rupees, and he wishes to start the investing journey with mutual funds, and his goals are as listed. Firstly, it's buying a house of 50 lakhs in the next 10 years. 10 lakhs in 5 years for marriage is something that he wants to save on, and 10 lakhs for travel in the next 10 years is what he's planning. So Marin, could you suggest how much money should he invest per month, and in which mutual funds, if you can just tell him, that he should be looking at?
So firstly, I think it's really nice to see someone who's just started earning is really looking at financial goals and looking at the right way to invest. So really, that's a good thing, Anurag. And now coming to the numbers, as far as the home purchase is concerned, he's looking at accumulating 50 lakhs at today's cost. So taking into account inflation, he'll need to invest rupees 1,37,000 in order to meet this particular goal. And as far as the marriage is concerned, it's around 17,000. And for the travel, it's around 8,000 rupees per month, right? So we've assumed the return on investment around 10%. It's a very, very conservative return that we've assumed, right? Now, clearly, there is going to be a shortfall on the amount that he can invest versus the amount that he needs to invest for his financial goals. And hence, I think what he does need to do in such a situation is start investing, but look at investments like equity funds. And again, he could just stick with index funds, flexi cap funds, and maybe some allocation to mid cap funds. But essentially, that's what I would advise him, because of the fact that there is a shortfall in what he needs to save versus what he's saving. And of course, in terms of the index funds, I always recommend a Nifty 50 index fund, which can be chosen basis the tracking error. On the flexi cap side, Parag Parikh remains my favorite. And of course, on the mid cap side, he could look at DSP or Mire. Again, if he does not really want to take that much risk in equities, and if he wants to balance out risk, he can always look at balanced advantage funds. But my suggestion would be to go in for equity funds.
Okay, so that's the correct age where you can actually go and look for equity funds, and the options that Marin just highlighted is what you should be looking at right now. But moving to our second query, Daksh writes that he's an entrepreneur based out of NCR, and currently he has been investing in the following mutual funds. And Amol, let's take this query with you. First mutual fund that he's investing is SBI Small Cap Fund, where he's investing 20,000 rupees. Tata Digital India Fund, 10,000 rupees. HDFC Mid Cap Opportunities Fund, another 10,000. So in total 40,000 per month he is investing, and he wants to build a corpus of 10 crores in the next 10 years to meet any emergency and expand his business as well. So he wants to know if he should stick to these mutual funds or there's another option that he should be looking at.
All right. So Daksh, let me answer this question in two parts. Number one is the financial goal vis-a-vis your existing investments, and then we'll cover the scheme parts. There is no other way for me to say this. Rupees 40,000 rupees SIP, 20 plus 10 plus 10 over next 10 years. No matter what happens to the market or any return that is generated by any of these schemes, it's simply not going to excuse me, it's simply not going to create a corpus of 10 crore rupees. So that is something that you should be very, very mindful about. 10 crore is a significantly higher goal, and it would need several decades or much higher per month SIP investment to reach that goal. That's my point number one. Point number two, let me now, having said that, let me try to give you what is the realistic goal. At a 12% CAGR, a 40,000 rupee SIP would accumulate somewhere closer to 90 lakh rupees in next 10 years. So that's something very, very realistic. It is only 10% of your required corpus. So you'll have to plan accordingly or make your goals or your investment amount, bring it make it slightly more realistic. And last but not the least, now the question of schemes. So I would say as an entrepreneur, as well as having a 10-year investment horizon, you have chosen within equity segment also, you have chosen riskier options like mid-cap and small-cap funds. If you have the risk appetite, that's fine. I would have just one suggestion. After mid and small-cap schemes, you have a thematic scheme. So I would say that instead of having an exposure via SIP to a thematic scheme, I would suggest go for a large cap fund and do the slight rebalancing. My recommended rebalancing is, even for a high risk investor, is 50% large cap and 25% each into mid and small caps. Daksh, I hope that gives you some clarity with respect to your question and as well as the scheme selection.
Absolutely, a bit short of time, so let's quickly move on to our next query. Mrin, let's take this query from you. So Chandrika writes that she is actually 25 years old and is employed at an MNC. So she wants to build a corpus of 1 crore in 15 years, and that's to pay off her 20 lakh education loan in the next 5 years. Her monthly income is actually around 1.5 lakhs and can invest 30 to 40,000 in mutual funds each month. So she wants fund suggestions to achieve her goals.
Well, first thing, the 1 crore after 15 years at a 5% inflation is going to be a little bit more than 2 crores. All right. So that's point number one. And the amount that she needs to invest for that is going to be 50,000 rupees per month, which is easily doable for her since her income is 1.5 lakhs. She's looking at investing 30 to 40,000. I think she can just increase that number to 50,000 rupees per month. Since she's looking at a 15-year period, I would recommend that she looks at taking some bit of risk. She can look at mid-cap funds. She can look at small cap funds as well. And in the small cap, I already talked about my fund recommendations earlier. So in the small cap category, I would recommend SBI small cap. But essentially, I would suggest her to be in mid and small cap funds, given that she has a long-term holding period.
Thank you so much, Mrin. And with this, we are completely out of time in this edition of the ET Money Show. So both the guests, Mrin as well as Amol, thank you so much for joining us today for this discussion and helping our viewers to curate their portfolio as of now.